Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on May 15th, 2026. We're Alina and Marcus.
If you look at the financial press this week, the headlines are, well, they're screaming about uninhibited growth.
Yes, perpetual momentum.
Exactly. Perpetual momentum and a fundamental economic acceleration. I mean, you would assume the market is breaking speed records with a perfectly tuned engine.
But if you actually look under the hood, the engine is stalling. Today we are looking at a market standing at a critical inflection point.
Because when we parse the underlying data, the structural setup reveals a deeply fragile landscape.
Right. And our objective in today's deep dive is to cut through that prevailing narrative. We are going to dissect the signal from the noise.
Which is crucial right now. We wanted to provide you with the clarity necessary to protect and optimally position your portfolio in an environment where, frankly, the apparent reality on the surface diverges sharply from the underlying mathematical truth.
So to understand this divergence, we really need to begin with the OCM regime map and the broader macroeconomic picture.
The foundation of our internal analysis relies on the OCM PCA model. PCA standing for Principal Component Analysis.
And before we get bogged down in the abstract mathematics of how PCA works, let's conceptualize it as a highly sophisticated acoustic filter.
I like that analogy.
Imagine the financial market is a chaotic, overwhelmingly loud concert. You have the screaming fans, the feedback from the amplifiers, the daily noise of headlines.
Geopolitical rumors, isolated earnings reports.
Precisely. All of that is high-frequency noise. The PCA model strips that away. It filters out the screaming to isolate the fundamental baseline. That baseline represents the primary underlying macro engines that are actually driving asset prices across the globe.
So applying that acoustic filter to the data today, our proprietary modeling officially defines the current market state as a regime of euphoria and reflation.
Which on the surface aligns with the consensus across the street. The prevailing narrative assumes uninhibited economic momentum.
Largely because equity indices, which are heavily weighted by a few specific mega-cap technology names, are soaring.
However, this is precisely where the signal separates from the noise. The OCM factor trends show us that while the absolute level of growth, what our model measures as global growth principal component 1, is deeply positive.
Sitting at the 94.6th percentile, to be exact.
Yes, 94.6 percentile. But its velocity has slammed on the brakes. The weekly growth impulse actually fell sharply by 1.36 points this week.
Wait, let me stop you right there because we need to address that directly. We just established that our own proprietary modeling explicitly defines the current regime as euphoria.
Yes.
So how can we simultaneously assert that the macroeconomic engine is stalling and velocity is dropping? Those two concepts seem fundamentally opposed.
It is a contradiction, and that contradiction is exactly what creates the current fragility. The absolute high in our growth factor is being mathematically driven by severe hypercyclical concentration.
Meaning we are seeing immense surges in specific, highly sensitive pockets of the global market.
Exactly. For instance, emerging market equities, specifically indices like the KOSPI and industrial commodities like copper.
Concurrently, defensive assets, particularly gold, have been deeply depressed relative to those cyclicals.
Right, because our model factors in the relative performance of these assets the extreme bid for hypercyclicals against the historical depression of defensives creates an absolute overarching reading of euphoria.
It masks the reality. It hides the fact that the underlying broad-based momentum, the actual velocity of the economic expansion, is rapidly decelerating.
To go back to our earlier analogy, the engine of the car is stalling, but the speedometer is temporarily stuck at a peak reading.
Because highly concentrated speculative capital is artificially propping up the needle.
Exactly. Which begs an immediate question. If the macroeconomic engine is genuinely stalling, whose money is actually keeping the speedometer pegged at all-time highs?
To answer this, we must examine the specific mechanics of investor positioning. We need to differentiate between systematic allocators and retail flows.
Let's define the systematic players first. We are specifically looking at commodity trading advisors, or CTAs.
You could think of CTAs as algorithmic surfers. These are massive, computer-driven institutional funds that operate strictly on mathematical trend-following models.
They do not care about the fundamental economic weather. They don't read earnings reports or analyze balance sheets.
No, they only care about the momentum of the wave. They are programmed to buy blindly when price momentum is positive and sell aggressively when that momentum breaks a specific moving average.
Currently, market intelligence shows these algorithmic surfers remain broadly long on global equities. They are riding the wave simply because the wave is currently moving upward.
Now, contrast that systematic behavior with the current retail investor landscape. Market intelligence indicates that retail participants are currently engaged in an absolute feeding frenzy.
There is an aggressive, practically indiscriminate reach for exposure, and it's heavily concentrated within the artificial intelligence boom.
Yes, this retail exuberance is providing a constant daily bid underneath the market.
However, when we analyze discretionary institutional flows, a very different picture emerges. Market intelligence reveals that hedge funds are actually exhibiting distinct risk-off behavior.
They are quietly but persistently net selling U.S. equities into this retail strength. Furthermore, they are actively degrossing.
Let's explain what degrossing means for a portfolio. It means they're reducing their overall footprint in the market.
They are selling off their long positions, but they're also covering their short positions.
Effectively shrinking their total market exposure to reduce risk. Specifically, we're seeing them pull capital out of the information technology sector and reallocate it into financials.
So we have smart institutional money quietly heading for the exits, reducing their exposure, while retail investors aggressively buy the top.
But the critical piece of market structure keeping the indices elevated is the CTA buffer.
The consensus across the street indicates that these systematic funds, those algorithmic surfers we discussed, have accumulated a remarkably wide buffer due to the prolonged, steady nature of this rally.
Right. Because the market has moved up so consistently, the moving averages that these algorithms use as their sell triggers are currently situated far below current spot prices.
To put a number on it, the broader market, specifically the S&P 500, would need to suffer a rapid drop of roughly 7 to 9% before those algorithmic sell triggers are breached.
And because those systematic sell triggers remain distant, the bus is currently being driven entirely by retail momentum and long-only dip buyers,
which has engineered an incredibly top-heavy market structure. The data confirms that an astonishing 85% of the S&P 500's year-to-date return is being driven by a handful of mega-cap technology names.
The breadth of the market, meaning the amount of individual companies actually participating in this rally, is severely deteriorating beneath the surface of the index level.
So to understand what catalyst could eventually slice through that 7 to 9% systematic buffer and trip those algorithmic sell triggers, we must pivot to the macroeconomic and policy backdrop.
We are observing severe macroeconomic headwinds actively fighting this technology-driven euphoria, and the primary antagonist is a persistent, sticky inflation.
The U.S. Core Consumer Price Index for April came in significantly hotter than expected. It printed a 38 basis points increase month over month.
Producer Price Index data is similarly elevated, demonstrating that wholesale input costs are re-accelerating before they even reach the consumer level.
This inflationary persistence has thoroughly dismantled the market's prior expectations for an accommodative Federal Reserve.
Earlier this year, the prevailing narrative assumed aggressive rate cuts were imminent.
Well, we are now firmly entrenched in a higher-for-longer monetary regime. The data indicates that market expectations for the first Federal Reserve rate cuts have been pushed all the way back to December 2026.
And in some models, March 2027. Consequently, the U.S. 10-year and 2-year Treasury yields are surging to multi-month highs.
We must translate what these surging yields mean for the real economy, because this directly impacts the viability of the current rally.
High yields, combined with rising energy costs, with Brent crude currently nearing $110 a barrel due to escalating Middle Eastern geopolitical tensions.
They act as a massive liquidity vacuum.
Let's unpack that liquidity vacuum. When the 10-year yield surges, it instantaneously increases the cost of capital for corporations.
It drains the cash that businesses desperately need for capital expenditures, research, and expansion.
If you are a company trying to finance new operations, the math simply becomes prohibitive.
Simultaneously, higher yields translate into higher mortgage and credit card rates for the regular consumer.
When everyday necessities and basic debt servicing cost more, discretionary consumer spending collapses. People start buying the marginal goods and services that drive corporate earnings.
This dual constraint squeezing corporate expansion while starving consumer spending directly threatens the long-term viability of the current, highly elevated stock market valuations.
The OCM-PCA model perfectly corroborates this fundamental deterioration. Our rates and reflation component is currently sitting at an extreme, overextended tactical exhaustion point,
registering at plus 1.49 sigma.
Let's put that in plain English. Registering at plus 1.49 sigma means we are at a statistical extreme.
It is a level of quantitative tension you rarely see outside of major violent market pivots.
It indicates that the market has aggressively front-loaded the pricing of inflation and rate risk to a point of maximum physical tension.
The rubber band is stretched as far as it can mathematically go before snapping back.
We are seeing this stress clearly manifest in the credit markets as well. Lower-tier corporate debt, spanning from Baa down to CCC tranches, is becoming increasingly vulnerable.
These are the companies that survive by constantly rolling over their debt.
As the 10-year yield remains elevated, the cost to refinance that debt becomes fatal. They are entirely exposed to the sustained liquidity drain.
Which brings us to the structural fragility of the actual market plumbing.
We have established that economic momentum is stalling.
The buying is narrowly driven by retail euphoria in tech.
And massive macroeconomic headwinds are draining global liquidity. Now, we need to demystify dealer gamma
And how Wall Street risk management dictates market volatility. Let's look at the pipes themselves.
To understand dealer gamma, we have to look at the mandate of Wall Street options dealers. They are the market's middlemen.
When an investor buys a call option, placing a bet that a stock will go up, the dealer takes the other side of that trade. They are effectively short that option.
But dealers are not in the business of directional speculation. They are in the business of collecting fees.
To protect their own balance sheet and remain perfectly neutral, they immediately buy shares of the underlying stock to hedge their exposure.
Under normal conditions, these options dealers act as the market's structural shock absorbers. Their mechanical hedging activity steadies the market.
When the market dips, they buy equities to adjust their exposure. When the market rises, they sell.
This creates a stabilizing buffer that dampens volatility. But right now, the market plumbing is severely distorted.
The retail feeding frenzy we discussed earlier has resulted in unprecedented one-sided demand.
Everyone is buying single-stock upside calls, particularly concentrated in technology and artificial intelligence names.
Because of this extreme asymmetrical demand, dealers are heavily positioned in what is called a short gamma profile.
The implications of a short gamma profile are profound. It means those structural shock absorbers have inverted.
If the market begins dropping rapidly, perhaps triggered by a macro shock, a geopolitical event, or simply a disappointing earnings print from a mega-cap tech name,
These dealers will no longer step in to buy the dip.
instead, the mathematics of their internal risk models will force them to sell aggressively into the declining market to protect themselves.
They transform from shock absorbers into active amplifiers.
Their forced selling violently speeds up the crash, creating a cascading liquidity vacuum that can easily slice right through that 7 to 9% systematic buffer we discussed earlier.
We are already seeing the warning signs of this mechanical instability. Market intelligence highlights a highly unusual spot-up vol-up tape.
In normal market physics, when stock prices go up, volatility measured by indices like the VIX goes down. The two are inversely correlated.
Currently, however, both equities and volatility are rising simultaneously.
This divergence signals that smart institutional money recognizes the extreme fragility of the short gamma plumbing.
They are actively and aggressively buying downside put protection. They are ensuring their portfolios against a sudden mechanical unwinding.
Which drives up the price of volatility even as the market hits new all-time highs.
Bringing all of these complex dynamics together, we must identify the pain trade.
The pain trade is the scenario where the consensus crowd is most likely caught off guard, resulting in severe losses.
The prevailing narrative currently operates under the delusion that the artificial intelligence rally covers all macroeconomic sins.
The crowd is entirely unprepared for the massive risk premium expansions that historically materialized during this specific phase of a euphoria state.
Let's define what a risk premium expansion means for your portfolio. It means investors suddenly demand a much higher return to justify taking on risk.
When that happens, the price of risky assets, like equities, drops sharply to meet that new required yield.
Our proprietary modeling warns that holding unhedged, long-only equity risk in this exact environment exposes your portfolio to a severe volatility trap.
When we look back at historical precedents where extreme absolute momentum collides with stalling growth velocity and overextended interest rates, the unwinding is invariably violent.
The data shows that from this precise setup, the VIX historically spikes an average of 8.84 points in the subsequent weeks.
An 8.84-point spike is not a gradual decline. It represents a sudden, mechanical repricing of risk where equity values crater simultaneously as panic sets in.
That is the pain trade, a swift contraction that the retail crowd is entirely unhedged for.
Therefore, the data dictates 4 clear, actionable summaries for your portfolio architecture heading into the coming week.
First, Adopt a strict long but hedged stance. The absolute worst strategy in this environment is to blindly chase the concentrated tech momentum at peak valuations.
You must maintain equity exposure to participate if the euphoria stretches further, but you absolutely cannot do so without insurance.
Second, systematically move up the quality spectrum. You need to rotate capital away from unprofitable, highly speculative tech names and allocate toward fundamentally robust companies with ironclad balance sheets.
We specifically advocate increasing weightings in consumer staples.
Why consumer staples? Because these are companies with established pricing power that provide necessary everyday goods.
They offer a defensive buffer. As discretionary consumer capital is drained by higher yields and sticky inflation, people will stop buying luxury electronics, but they will not stop buying basic household necessities.
Third, keep your fixed income duration exceptionally short. With inflation proving sticky and the Federal Reserve sidelined until late 2026, the long end of the yield curve is highly toxic.
Avoid long-term bonds. Their principal value will continue to erode as the 10-year yield surges.
Keep your capital in short-duration instruments to capture the currently high yields without taking on extreme interest rate risk.
Fourth, and perhaps most importantly, execute the purchase of volatility protection immediately. Buy put options or dedicated tail risk hedges.
Because the broader market is currently drowning in complacency, the pricing for downside insurance is incredibly cheap right now.
You are essentially buying fire insurance on a wooden house while the neighborhood is experiencing a drought, simply because the insurance salesman hasn't checked the weather report.
We want to leave you with a final provocative scenario that our internal models currently treat as a tail risk, but one that is steadily gathering statistical probability.
What if this current deceleration in growth isn't just a temporary breather?
Yeah.
What if it is the early stages of an entrenched stagflationary environment?
Look beneath the surface of the indices. Consumer finance equities, the companies that issue credit cards and personal loans, are quietly being sold off.
This reflects severe underlying weakness in everyday consumer health that is completely ignored by the headline euphoria.
If the AI tech fever breaks, the facade will fall. The stark reality of the struggling, over-leveraged consumer is going to become the only story in town.
And that will fundamentally reset equity valuations across the board.
See you next week, wherever the flows take us.